You need to heed this warning in time. Some of the most catastrophic economic recessions in history have started from a single large industry, and it seems like the aftermath of 2020 is making the restaurant business another block in the domino to fall. That's exactly what Patrick Bet David wants you to know, having been in the insurance industry and knowing how to economic risks his entire life. But there's some important context and statistics I want to give you, so subscribe to the channel. This is not financial advice, and let's watch the next clip before we dive into it.
Kevin O'Leary explains why restaurants are shuttering across America and why more will follow. He highlights the U.S. restaurant industry dire situation, noting the U.S. restaurant industry finds itself on a menu with frequent headlines about bankruptcies, layoffs, and closures impacting beloved brands like Red Lobster, Applebee's, due to inflation and declining foot traffic post-pandemic. He adds, seemingly every day there's a headline announcing a bankruptcy, layoff, or store closure impacting one of the country's most beloved brands. O'Leary explains that rising food prices and the shift to remote work has significantly hurt restaurants, especially in urban areas where expensive locations are no longer seeing enough foot traffic. He notes eateries in urban locations have been hit especially hard as their expensive locations are no longer receiving the footfall they need to meet rent. It's almost like the days where you used to go to a dealership to buy a car, and nowadays you don't necessarily need to go to a dealership because you do what? You can order a car and it'll come to you. I think Uber Eats has probably played a big role in hurting these guys as well, Tom.
Remember, the restaurant industry is the second largest private sector employer in the United States at over 15.5 million people working in the industry, which is a staggering 10% of the entire national workforce. In fact, I was also in restaurants for about 10 years, and more than 90% of those consist of small restaurants and family-owned businesses, usually employing less than 50 people in total. And you start to see the picture. The lockdowns in the aftermath of 2020 came at the greatest peril to restaurants because the industry took the greatest hit of job losses in the following year. Now, of course, restaurants have started to climb back up from 2020 levels. There's been a fundamental change in public attitude towards restaurants that does not spell great news for the industry. It was a consistent theme after the events of the 2020 that brick and mortar businesses almost came to a scathing halt, and a lot of their lost revenue went into business that were more friendly and a lockdown scenario. That's why you saw companies like the co-working space brand WeWork suffer a severe downturn, and companies like Zoom and Uber Eats see growth they could never have guessed. But perhaps no such downturn can have as potentially damaging impact as an industry as large as the restaurant business. More than 72,000 restaurants in the United States closed in the 3 years after 2020, creating a massive disruption not just in the lives of hundreds of thousands of employees, but also creating a ripple effect on delicate global supply chains that have not been able to recuperate even today. And while it's true that a lot of lost revenue is flowing to new businesses, perhaps the American economy cannot sustain a massive blow to such a large industry without risk of triggering a larger recession.
Look at the increase from 2018 to 2019. Not a big increase. Wow. It's only 20%. But look at the increase from 2019 to 2020, nearly 3x. Wow. Okay. Then 2021, they double again. Then 2022, coming a couple of the restrictions are gone, 10.9, 12.1. But that business of going from 1.9, if you look at it, 1.9 to 12.1 billion, that's all money taken away from somebody. But go lower because that's not the real number. Keep going. That's what Uber Eats made, revenue to them. But go down to how much revenue was the food. Go lower, Rob. This is the actual bookings, okay? Look at that. 3.1 billion to 7.9 billion to 14.5 billion to 30.2 billion to 51.6, 55.7, 67.8 billion dollars. Wow. That's money going away from somebody.
And it's going away from the restaurant and dine-in businesses that are seeing profits fall while taxation and minimum wages rise. It's only so long before this extraction of lifeblood revenue means the industry can no longer remain standing on its own. Uber Eats is doing it to restaurants what Netflix did to cinema houses, except cinemas were never such a large piece of the economic pie as the restaurant business. They're intricately connected to agriculture, transportation, packaging, and most importantly, commercial real estate. That's where the rubber hits the road because most restaurants operate on rented commercial real estate, which constitutes about 10 to 15% of their total expenses. Commercial realtors that have also been very interested in renting out to restaurants, given their historical size and reliability. And if you understand, for example, how McDonald's operates, you know another angle in which restaurants are tied to the real estate industry. McDonald's sets out the example of the franchise model long ago, buying or leasing land in important locations and selling franchise licenses to earn continuous royalties and fees. Today, many fast food giants operate on that basis, and that means even a 20% drop in their total profits can eat into the viability of their very physical existence as a building on top of land. This has forced many smaller restaurants to go along with the tide and turn into takeaway kitchens and restaurants partnered with a food delivery app. But clearly that flow of revenue does not bring over the supply chains connected to the restaurant businesses. And a major contraction of the restaurant industry can have crippling effects on more than a dozen other industries, potentially cascading to a contraction of the economy at large.
I have some commentary here, but more from a macro perspective, not necessarily just the food industry, because I like how you kind of broke it down, whether it's Uber, whether it's these restaurants, whatever it is. But from a macro perspective, and then to kind of filter it down to a personal perspective, this is just Darwinism. This is just survival of the fittest. Can you adapt? What do I mean? You know, what percentage of the companies that were in the Fortune 500 in 1950 or even in 1990 are still in the Fortune 500? We hear the stories that it's like the attrition rate is insane. 50% of the companies go out of Fortune 500. I think 10% of the companies that were the biggest companies in the world in 1980 are still in the Fortune 500. How many companies have gone out of business? Whether it's WAMU, you tell that story, whether it's Lehman Brothers, whether it's Bear Stearns, you tell the story about Kmart, JCPenney, Bed Bath & Beyond, Radio Shack, Blockbuster. These were the biggest companies in the world. WeWork, 2 years ago, what was it? Silicon Valley Bank and Signature Bank. If you can't adapt and change with the times and you make poor decisions and you go on offense and you don't play defense, i.e., paying for lobbying, you could potentially go out of business. And I'll bring it to what PBD always says: outwork, out-improve, out-strategize, and then what's the last thing, PBD? Outlast. If you don't do all those four things, you're not going to outlast the market.
There's truth to that, because Adam Smith's economic theories and Charles Darwin's understanding of life and evolution do have significant overlap, but in both biology and economy, that process of creative destruction is not without its damage and loss. And in a world that's as precarious as it is, Patrick Bet-David's warning about an economic recession rings closer than it ever has.